Today, we're diving into RSUs and the three things that you need to know about granted RSUs and vested RSUs. My name's Sam. I'm a certified financial planner, and I have an independent wealth management firm, and I work with millennials in the technology field to really help them navigate some of these complexities with equity compensation. Today, we're diving deep into RSUs because RSUs are pretty much the most common type of equity compensation that I see my clients have. Now, there's some other types of equity compensation as well. There's employee share purchase plans, there's stock options, there's stock appreciation rights, there's all sorts of other things, but these are the most common and the most widely used by the big tech firms. Now, the first thing I'm going to dive into, and the first thing that people should do when they receive RSUs is going to be diversify. Why would you diversify? Right? Because who knows? Your company could 10x and then you'd be a millionaire, and you're 100% right. Typically, though, that's not the likely scenario. Even companies that have 10x that you may be working at are unlikely to 10x again while you're working there. So let's look at the risks of not diversifying, because if you don't diversify, then that means your human capital, which is your ability and location of income that you earn, and your investment capital, which is the amount that you save, will be locked into one place. And that means there's limited diversification. What we saw, and there was a painful lesson of this in oil in 2014, was the oil industry took a huge hit in 2013, 2014. Most people got laid off, and they also were heavily invested in oil, and they lost their life savings. I was working as a teller at the credit union at that time, and this was in Saskatchewan. And we had so many people who worked in oil call in. They had their big trucks that they'd leased, they had their cottages, they had their homes, because these are general laborers earning 100K plus, and they were maxed out to the nines. They also had all of their pension investments and all of their RSPs invested in oil, and they lost their jobs, and they lost a good part of their investment portfolio. So we don't want to have that happen if you work in tech. So even though, yes, you might be sacrificing a 10x return, you can still get really good returns by being broadly diversified in an index fund or something of the equivalent inside of an RSP or tax-free savings account. So the number one thing is, do not let your human capital and your investment capital be locked into the same place. The second thing is to look at the tax side of RSUs. So RSUs are not taxed when they're granted, they're taxed when they're vested. And that's completely different. So vesting is when you actually receive the shares. Now, as many of you may know, 50% of your vested shares are gone to taxes, and that's kind of a bummer. But realistically, if you're not actually earning that much in terms of you shouldn't have gotten taxed at 50%, you'll get a tax refund coming back to you in cash. Now, what should you do with that net 50% of RSUs? So the tax impact, first of all, is that the RSUs are treated as ordinary income. Meaning, if you were to then contribute your net proceeds to an RRSP, you would get a lot of that tax that you paid back. So that's strategy number one, is you could contribute your RSUs once you've sold them to an RRSP, or you could even move them still in the company stock into an RRSP, although it will trigger a sale and there will be taxes owed if there's a capital gain. Now, the other thing to keep in mind is that there's that secondary tax, right? So you've got the initial tax on vesting, which is the income tax. Then you've got the capital gains tax if there's a gain in the vested shares. So you can then essentially, instead of waiting a long time and deciding what to do with your RSUs, you can cut those shares off right as soon as you get them vested, so that there is limited capital gains. Now, if there's limited capital gains, great. You've got the net proceeds. You can decide what to do with them. If you don't want to contribute to an RSP and get the majority of the tax you've paid back, then you can put them in your tax-free savings account. So that way, the future growth on them is tax-free. So there's a couple things you can do to avoid the first tax. One is to contribute to an RSP. You'll get most of it back. Another thing is, you could contribute, if you'd like to donate, you could contribute to a donor-advised fund, or you can contribute your appreciated stocks directly to a charity. I like the donor advised fund method because essentially you make the charitable contribution, but you're still in control of the stock, and you can choose what charity you want it to go to at whatever point in time you actually want to give the money. You get the tax credit for the full amount of the contribution to the charity, and you don't have any tax hit. So you get a tax credit, giving you money back in taxes. About depending on what your income is at, that'll be determine the tax credit you get back. and you still maintain control over the funds with a donor advised fund. And that's just a great position to be in if you're philanthropically inclined, which many of our clients are. So, in summary, if you have RS, ensure you understand the tax implications. There's the first and the second tax. The first is the income tax, the second is the capital gains tax. Ensure you know what your strategy is. Are you going to put them in an RRSP to avoid a lot of the first tax? Are you going to sell them right away to avoid the second tax? Maybe transfer to a TFSA. If you still want it to own company stock, you could buy it back inside your TFSA, right? And then avoid any future capital gains hits. So there's a few things you can do with that. Remember, diversify because you don't want your human capital and your investment capital tied up in the same place. As well, you can also contribute to a donor advised fund, get a tax credit for a donation, and still maintain control of that and donate to a charity of your choice at a later point in time. Guys, my name's Sam. I'm a certified financial planner with Millen Wealth Advisors, where we help tech employees and entrepreneurs manage these complex decisions of what to do with equity compensation. If you want to learn more, feel free to reach out. But for now, click subscribe and I'll see you in the next video.